What's up, Money Geeks? Mr. V here, Plenties.com. Real quick though, if this is your first time here, I teach people how to become and stay debt free, save money and invest. So if that interests you, go ahead and hit that subscribe button. So in today's video, I'm going to take you guys through comparing ETFs and index funds. So last week I did a video on how to open a Vanguard brokerage account. So if you haven't already watched that video, I'm going to hook it up here. Go back and check that video. I'm going to give you a step-by-step approach on how you open a Vanguard brokerage account. So once you open that account, get verified, and you put money in the account by either connecting directly with your savings account or your checking account. That money goes into a Vanguard money market fund. So it stays in that fund, which it pays a little bit of interest, but nothing that can make you rich overnight. It's not going to make you a millionaire. But that is the holding fund before you can then use that money now to buy all the different asset classes that you want to buy. So I'm assuming that you've already opened your account, which is very easy. It takes less than 24 hours, even less than 8 hours in some cases, for you to have the account open. So once you have your account open and you've funded the account, so what are you ready for? Investing. You're ready to start buying your own asset. And so there's so many different asset classes you can buy within Vanguard. You can buy ETFs, you can buy index funds, you can buy mutual funds, you can buy some bond funds. There's a lot. You can buy individual stocks. There's a lot of asset classes you can buy in there. But I'm focusing on two things here. I'm focusing on index funds and ETFs, and why that's where I'm putting my money. Before we jump into, I want to show you guys today the differences between ETFs and index funds, and even the similarities between those two. And that's where my money is at. And if you go and look at the top investors out there, and they encourage you to try to invest in this asset class because of the diversity in this asset class and the low risk that you'll find in this asset class. So let's go out there, take a look at how the difference between index funds and ETFs, and then what we're going to do is we're going to take one ETF and one index fund, and I'll show you guys in depth into what those funds actually look like. And then after that, we're going to come back, and then next week I'm going to show you guys how you can actually open a brokerage account with any of the other brokerage out there to buy individual stocks. When it comes to individual stocks, I don't buy them in Vanguard. I buy them with another platform, and I'm going to do a video on that next week. I actually have two platforms now that I'm actually using. I use Robinhood and I use Stockpile. I did a video just overview of those two. I'm going to hook it up here, and in those platforms you get free money to start with. So next week I'm going to walk through a step-by-step on how to open your investment account using those two platforms. So let's jump into my computer, compare index fund and mutual funds, and why I invest in those two. So here we go, guys. This is the steps that I showed last week for you to open your Vanguard account. So step 1, 2, 3. So I'm assuming that you've already gone through this. You have your account ready to go with some money in there. So we're just going to skip through this. And again, if you didn't watch that video, I'm going to hook it up here for you to go out and check it out. So ETFs, and like I said, those are the two main asset classes I invest my money in, are ETFs and index funds. So what are ETFs? ETFs are exchange traded funds, and so ETFs are pretty much like stocks. So if you've ever bought stocks, ETFs are the same way when it comes to buying them. You buy them like you buy regular stocks, but the only difference is that they are a combination of different stocks. So an ETF could have, let's say, technology ETF could have Microsoft, have Google, have Facebook, have Amazon in there. So that way you have less risk. So if one asset class is going down, the other class will keep them afloat. So that's how ETFs do work. So I know people hear about it and everybody panics. So I encourage you to go out to Vanguard.com and just read a little bit about them. It is so easy to understand, and they're really a good asset class to invest in. So I'm going to move on next here. And so these are some of the reasons why you want ETFs over individual stocks. For long-term investment, I'm not really a big fan of individual stocks, because you never really know. So I try to give myself an opportunity with a balanced portfolio. So if things are going south, at least I still, have some stuff that keeps me afloat. So ETFs have less risk. ETF has less work, and let me explain the work. I just explained about the risk. The work part is that once you buy it, you can just put it there and sit and watch. You don't have to do anything or move stuff around. Usually, when you have individual stocks, let's say for instance, Microsoft start going down so bad, what do you have to do? You have to go maybe start selling, short selling, and doing all the work that you have to. You have to stay on top of it actively, checking it every day, making sure that there's not some bad news about Microsoft in China that's going to make the stocks go down. So with ETF, that work is reduced for you. Then the cost is pretty much low too. So you buy ETFs, and once you buy and put in a portfolio, especially with Vanguard, which is, I'm going to talk about the fees here. It's pretty straightforward. It's just low cost. You don't have to spend a ton of money to actually own ETFs. So that's something we're worried about. So ETFs now versus mutual funds, or what I call index funds, or in some of the other cases. So you can have index funds or mutual funds, but an ETF are a separate class on the other. So let's look at ETFs and mutual funds here. Similarities between them. So what do you see? Both are less risky. Both are they offer a wide variety of investment options. Both overseen by professionals, portfolio managers, and then both are commission free. At Vanguard, this is key. They are commission free at Vanguard. And that's why I use Vanguard. And I only buy Vanguard funds and ETFs, because when you buy them on Vanguard, the fees are waived. So you only pay the expense ratio on that fund, but there's no fee. So when you talk about a commission free, let me explain what that means. If you go to Vanguard.com and you want to buy, let's say, a stock of Microsoft, or you want to buy an ETF that is not owned by Vanguard, let's say it's a Fidelity ETF sold by Vanguard, you're going to pay $7.30 for your transaction. So when you buy, you pay $7.30. You sell it, you pay $7.30. But if you were to buy a similar ETF or mutual fund on Vanguard that is owned by Vanguard, that fee is waived. It's so beautiful. I love it. So that's something you need to consider. And then next, what are index funds? Index funds are a combination. So you can still buy index funds just like you would on the stock market, buy the different combination of stocks or bonds or whatever within that fund. So a portfolio manager would handpick different stocks and different bonds or whatever, and package them together and then sell them as an index fund. Again, the beauty here is that it's low cost, low risk, and very tax efficient. So that's something that you want to look into. Then we're going to go through and see the differences between ETFs and index funds, so that way you can decide what you want to invest your money in. Me in particular, I have both ETFs and index fund, and I'm going to show you guys here shortly. And so these are the differences. So if you're looking for a lower investment minimum, so when they say a lower investment minimum means how much money can you put up front. Let's say you're just starting out like we're doing with this video, and you're doing your first investment. Which one should you pick, ETFs or index fund? And in this case, ETFs would be better for you because ETFs have a lower minimum amount to start with. So you can go and buy one share of an ETF, and that would be okay. But for index fund, you have a minimum amount that you need to start with. In some cases, the minimum amount could be about $3,000, like it clearly states here, up to about $3,000. So not everybody can afford $3,000 to start with. So I encourage those people to start with index funds because they're cheaper, easy to start with, no minimum to start with. So if you have $100, you can go out and buy you some ETFs, and I can show you some of the ETFs out here. And so if you want more hands-on control over the price of your trade, no, and I'll say, yeah, go and get ETFs, because ETFs they follow the market. So the price of an ETF starts in the morning at 8 o'clock and changes throughout the day until at 4 p.m. Eastern time when the market closes. Whereas mutual funds don't follow that same path. They don't really work like stocks do. When you start in the morning, they don't really follow the market hour by hour until 4. So they usually would work at the end of the market. That's where the price is. They take the price at the end of the day, and that's what you get for mutual funds. All right. So if you want to repeat specific transaction automatically, so in this case, I'll tell you that mutual funds or index funds will be the best option for you. And here's why. Let's say you want to automate your process, because I've had people ask me the question, hey, Mr. V, if I just want to automate this whole thing and just lay back and grab a beer and relax, I don't want to be sweating about it every day. So which one should I go with? In this case, index funds will be your best option, because you can set automatic transfer from your bank account into your money market fund, which automatically get invested. All those things, you can set them up. So every month, money will just move from your bank account into your Vanguard account and buy funds for you. And then one of the things you can do too for dividends that get paid on the index funds that you have, those dividends can be reinvested. So that way you don't have to do anything. All you have to do, check in from time to time and see your money grow, and that's about it. You don't really have to worry about anything. And so if you're looking for an index fund, and then go out there and choose whichever index fund that works for you, and just again, do your research. Do your research before investing. And so this is what my portfolio, one of my portfolios look like right now. So I have 2 index funds up here, and I have 2 ETFs down here. In key thing they want to look at here is this whole expense ratio. If you look at the expense ratio here, they are very, very low. 0.04, 0.05, 0.08, 0.1. That's the most expensive one, and it's because this particular ETFs pays. I'll show you guys the graph. It's been crazy. The graph of this technology ETF is insane, and so I don't mind paying the 0.1% for the expense ratio, just because the returns there are really, really massive. And so this is the price of this particular assets that I have, and then this is the change. And so I blacked out some of the stuff just because I choose to. And then so when I mentioned about the money market funds, this is where, so when I transfer money from my bank account, that comes into here and stays here. So right now I have $144.66 ready to invest. So if I want to buy, let's say the Vanguard Dividend Appreciation ETF, I'll come here. It's $99.36. I'll buy it, and that would get added there. So that's how you could do it. So if you have $100 or you have $200, this is where you can start. You have a VGI is an easy one where you can easily start and get going. The other ones up here, they have minimum amounts that you have to worry about. So and so that's it for this. So here is the VGT ETF, and so VGT is Vanguard Information Technology ETF. And so when you come in here, it shows you the risk. It's very, very high risk, so that's why it's at 5. And then it shows you like the expense ratio, and then if you want to see the detail, this is the graph. So let's go to price and performance. So that was overview, and so the last price as of today has been 172.94. 52-week low is $139. So that is a huge change. So from 139 to 184 for a 52-week high. That's quite a big shift. Then if you see, this is like a hypothetical investment over 10 years. So if you put in $10,000 in this fund over 10 years, this is the max. It would have gotten to $35,000, which is crazy. Yeah. So if you put in $10,000 here over 10 years, so 2008 to 2018. That $10,000 would be worth about $35,000 right now. That's insane. And so these are the returns over the years. So 5-year return, 10-year return, and then since inception. So these are the returns that you see. And so that's how I look at the stocks in depth. And then I go to portfolio and management. It gives you some key metrics here. But the one thing I want to look at is what is in that particular ETF. So here you have Apple, Microsoft, Alphabet, which is Google, Facebook, Intel, Visa, Cisco, MasterCard, Oracle, Nvidia. And so 10 really awesome companies that are in there. So, and I don't see any of this company going anywhere anytime soon. So that's where I have my money, and I believe in this, and it's been working really great for me. So that is ETF. So if we switch gears and then look at, here would be an index fund. And so this particular index is a domestic index, and overview here again, the risk is 4, which is significantly high. And then let's switch to the price and performance so you guys can see. So the 52-week high has been $78 and 52-week low $63. That's still pretty good. So if you invested $10,000 in this fund since 2008 to 2018, it would be worth $27,000, about 20, yeah, give and take $27,000, which is good. So that's awesome. If you look at the returns over 10 years, 10%, that's really good. 9.5% since inception. That is awesome. And so if we go to the portfolio, so if you look at this is a growth, large cap growth fund index. And then if we switch down here, if you go down and look at the composition, again, if you see this particular index fund, it mimics the exact ETF that we just looked at, the technology ETF that we looked at. So hey, take a look at these guys. And this is why this thing is so funny, and then we still don't understand it. Look, all these companies here is the exact same. I don't see anything from Apple, Microsoft, Alphabet, Facebook, Intel, Visa, Cisco, MasterCard, Oracle, and Nvidia. Same thing here. Oracle, Nvidia, everything exact same. But guess what? One is an index fund, the other one is an ETF. And look at this one brings back this much in return, and this one brings back just this much in return. See? All right, and then let's go to fees and minimum, and this is another key thing. So if you look here, the minimum for this particular index fund is $3,000. So for you to buy one or to get into this index fund, you need at least $3,000 to get started with. Whereas its counterpart, the ETF, guess what? Let's go to fees. See, there's no minimum, so you can start with whatever. So if you have $100, that's where you want to start. So VGT is a great index fund, and I love it. And so these are just some of the fees that bank that shows you how much you save over time and all the good stuff. So I hope this was useful information for you. Again, please invest at your own risk. Do your research. Make sure you understand this stuff before you put your money out there. The stock market is no guarantee. We're all taking chances out here. So I would encourage you to do your homework before you invest your money. It's your hard-earned money. Don't just put it out there because somebody said, oh, this is gonna explode. Do some homework, read, understand some of these terminologies. I taught myself this whole thing from zero. I had no idea what people were speaking. To me, it felt like a foreign language. But now I feel comfortable doing it. I'm not saying that I'm like the best of the best, but so far I would have been paying somebody to manage my portfolio, and I'm doing it myself and saving myself a lot of money. So yeah, it's something that you can definitely do. So I hope this video was useful for you guys. So there you go, guys. Those are the two asset classes in which I predominantly invest in. So index funds and ETFs, those are my two primary asset class. So question of the day, what asset class do you invest in? Let me know in the comment section. If you enjoyed the video, go ahead and give it a thumbs up. If you find it useful, share with one friend. And if you can relate to what I'm talking about here, helping people save money, invest, and get out of debt, definitely let me know in the comment section. I release new videos every week on life, career, and money, and how to become debt free. So if you don't want to miss it, hit the subscribe button. And as always, keep crushing that debt, and we'll talk soon.